Let's talk about investing in stocks. It's possible to buy stock in thousands of publicly traded companies, and chances are your portfolio will probably include most of all of what's available. When you buy stock in a corporation or a stock mutual fund or ETF, you become one of its owners. If the company or companies in your fund does well, you may receive part of the profits in the form of dividends and see the price of your stock increase. But if the stock price falls, the value of your investments can drop, sometimes substantially. At any given time, the value of your stocks depend on whether its shareholders want to hold it or sell it, and what other investors are willing to pay for it. If the stock is hot and lots of people want shares, it's reasonable to expect the price will go up. If a company is losing money, on the other hand, or a particular industry or sector is doing poorly, those stocks may decline in value. Some stocks are undervalued, which means they sell for less than what they may be worth, while others may be expensive relative to its book value. So how do investors make their money in stocks? A couple different ways. Through dividend payments and/or by selling the stock for more than what they paid for it. Talk a little bit about market cycles. The stock market, whether in the US or internationally, goes through cycles, heading up for a time, and then correcting itself by reversing and heading down. A rising period is known as a bull market, bulls being optimists who drive the prices up. On the other hand, a bear market is a declining market, where stock prices fall. A bear market is generally defined as a 20% or more decline, and it may remain depressed. It's not out of the ordinary for markets to move up or down 2 to 3% in a given trading day. But overall, the market has tended to rise higher following a fall, though it sometimes may take a long time to reach its previous high. Investor attitudes. Some people hesitate to invest in the stock market because they consider it too risky. Afraid of choosing the wrong stock or being battered in a bear market, they prefer to stick with investments they consider safe. The problem with that approach is that by avoiding stocks, investors are missing out on a potential source of long-term gains. While you could lose money in individual years or on a single individual stock, investors who have held a portfolio of stocks through any 15-year period have generally come out ahead. Usually the greater danger is not sticking with stocks. Investors who sell their shares when the market drops rather than riding out the downturn have been more likely to lose money than people who left their portfolios alone or those who bought additional shares when prices were temporarily depressed. The caution that past performance is no guarantee of future profits is absolutely valid. Investing isn't about guarantees. It's about balancing risk with reasonable expectations of reward. Taxes. The dividends you earn on stocks and any capital gain or profit you have when you sell are taxable in the year you execute the trade, unless you bought the stock through an IRA or a tax-deferred retirement plan.